Hey, everybody out there. Once again, we have Mark Collinsworth with us, our local financial expert of Vera Global Wealth Management. And Mark, the big news now financially is the Feds have decided to keep interest rates as they are. And then they also indicated they'd be lowering them 3 times before the end of this year. So what does that mean? Good news or bad news for the investment world? What do you think?
Well, thank you, Larry. It was good news for the stock market, but going into the meeting, the rate cuts, potential rate cuts for this year, everyone kind of already knew that. But what got the stock market going was Jeremy Powell in his speech said they're actually going to slow down their bond sales from all the bonds they've been buying up through quantitative easing. They've been selling those bonds off. They're actually going to slow the pace of that. That's what caught everybody off guard. That's sparked this huge rally here in the last 2 days.
Now, some of the media, at least some of the mainstream media, is saying that the rally in the stock market was due to the announcement that they would be lowering interest rates 3 times before the end of the year. Correct? That was their reading on it.
That, that's what the media says, but of course, the media, they're journalists. I don't get into journalist business. I don't like it when journalists get into my business. I knew the Fed's going to cut rates, so that was no big surprise to me that they made that announcement they're going to cut rates sometime this year. What caught me totally off guard was it's going to slow down bond sales off their balance sheet, and that's actually what sparked me after he said that. I actually started buying stocks very aggressively on that prior to um, cutting rates 3 times. I just sat back in my chair like, oh, no big deal. But him on the bonds reduction, that was a very big deal. It sparked me to start aggressively buying stocks that day.
Okay, and explain a little bit more to the layman who's not familiar with all this, why it works that way, the mechanism behind it.
Well, so during the financial crisis of COVID, and even going back all the way to 2008, the Federal Reserve has been going in and buying Treasury bonds, which has lowered yield. So your mortgage rate's actually tied to the 10-year Treasury bond. So if the Fed's buying the 10-year Treasury bond, that's pulling the yield down, which is pulling your mortgage rates down. So they have basically $7 trillion on their balance sheet in these bonds. They have now been selling them off, and as they've been selling them off, that's caused interest rates to go up. You've probably seen it a lot in your mortgage rates because they're selling the 10-year Treasury bonds, which are making mortgage rates go up, causing the economy to slow. Now, if they're going to slow down that pace, mortgage rates should also stabilize and not be going up as much as they have been. So they should stabilize here over the next few months.
Okay, now their basic announcement was that they're leaving the interest rates at the same level this time around. Now that was decided because they still have to tamp down inflation more than it's been tamped down, correct?
Correct. The inflation rate is a little bit higher than what they want it to be. And that was one of the things you noticed in the dot plots, which is where every Federal Reserve member gets to make a forecast on where they think interest rates are going to be at over the next, 6 months, 12 months, and a few years out. So based on the Fed governors voting on the dot plot, the terminal rate, which is what they think the fair value of the Fed funds rate should be, is actually going to be higher. So um, historically, the fair value has been around, let's say, 2%. Based on the dot plot, it looks more like 4 to 4.5% will be the long term the base rate for the Fed funds rate. So higher for longer is in play.
Once again, Mark, the dot
All right.
plot is what in layman's terms?
The dot plot is where each Federal Reserve governor actually gets to vote where they think or make a guess on where they think the Fed funds rate is going to be at 6 months, 12 months, 18 months down the road. And based on that, that's where they're getting into the speculation there's going to be 3 rate cuts because so many Fed governors who are voting on it say the interest rate should be anywhere between 2 cuts to 3 cuts over the next 12 months. But what's interesting, if you go out beyond next year, they actually have no rate cuts on the dot plot, which basically means the base rate for the Fed funds rate will be higher than what it historically been. So, long story short, people who've gotten used to the super low interest rates of 1 and 2%, those days are long, long gone based on the dot plot. Yes, interest rates are going to come down, but they're not going to get anywhere back down to where they used to be at
And not for any time soon, at least, huh?
anytime soon. Correct.
Okay, Mark, the big question is the Fed, either helps or hurts an incumbent president in an election year. We are approaching the election in November. So this announcement that was made this week, is it going to help or hurt Biden going into the election day in November?
it will actually help Joe Biden going into the election. That's one of the things ever since the 1992 election between George Bush and Bill Clinton. Fed caught a lot of heat for raising interest rates in that year because they felt like the Fed was basically trying to push the election in a certain direction of keeping George Bush Sr. from getting elected. And the Fed's always kind of had an unwritten rule where they will absolutely not do anything in an election year because they don't want to make it look like they are biased towards a political party. If the Fed cuts interest rates this year, this will be one of the extremely rare occasions the Fed has actually made a move in an election year. And by cutting rates helps out the incumbent president a lot more than it hurts them.
Okay, how much will it help them before November?
It will help them out quite a bit.
Quite a bit. So the
Quite a bit.
economy will be looking better for Joe Biden, who could take credit for it going into the election this year in November.
Correct. It'll help out the stock market. It will help out a lot of things. And, just looking at it, if you look at, a lot of people say that Joe Biden will lose the election. But, if you look at it, every incumbent president that has lost an election or been a one-term president, all of them had one thing in common. And that was each one of them had a recession going on during the election period. You look at Donald Trump, 2020 with the COVID. Look at George Bush Sr. You had, the Gulf War and the recession there in the early 90s and Jimmy Carter. So unless a recession happens, the incumbent president will be reelected.
So, but how much will this really result in a recovery of the economy by November? I mean, people are still, feeling the effects of the Biden economy, the credit cards, gas prices, food prices, et cetera, et cetera, et cetera. So you're saying most of that's going to go away now because of this announcement before Election Day?
No, it won't go away. But what people are going to notice is the interest rate on their credit cards are going to come down. They're going to notice that they have more money to spend. So even though inflation has gone up, let's say, inflation has cost you an extra $100 per month. Well, if you lower interest rates on your credit cards and you're now saving $150 in interest payments on your credit card, now everybody's happy.
And how about food prices?
Still, it's the same thing. Food prices might be heavier, but if you're lowering your interest rate on your credit card, then you're a lot happier on what you're spending at the store.
So in other words, food prices and other commodities won't come down that much, but credit card interest rates will, and that's enough to get Joe Biden reelected? That's what you're
That
saying?
is correct. Yep. Yep.
Really? So
Yep.
you're predicting today, this week, that Joe Biden will be reelected.
Correct. I mean, a lot could change between here and now, but it's just not looking good for Donald Trump. I mean, if you look at, like I think last month, Joe Biden set an all-time record for the most money ever raised by the Democratic Party. And then you look over here at Donald Trump. Donald Trump's donations is well below what they have been back, in 2016. So, like they say, money really determines who's going to be the president. Right now, Joe Biden holds the upper hand in the amount of money he has in his war chest.
Wow. All right, Mark. Thanks for the what I find a surprising update from you, because until now, it didn't look like the would have been very good for Joe Biden coming into this election. But now you're saying this is going to turn it around.
This could actually help him out quite a bit. He's got fundraising on his side. You've got all these problems. I mean, look at the primaries. The primaries is a perfect example. Donald Trump was going up against Nikki Haley, and yeah, he was getting 70% of the votes in the primaries, but Nikki Haley was taking 30% fairly consistently. Yeah, he was still killing her. That basically tells you that 30% of the people that voted in the primaries aren't going to vote for Donald Trump in the actual election. So that's going to be a huge number against him.
How about illegal immigration? I mean, that's a top concern in many states, even the swing states.
It is a big issue, but that's also a thing. I mean, I don't want to say that the election was stolen in 2020, but there was a lot of practices that were done in the election that historically had not been done that actually hurt Donald Trump and actually helped Joe Biden. I think, they're going to try their best to push those same issues again this time around to actually take their hands off some of the laws, if that kind of makes sense.
Okay, but again, Mark, the border crisis, the increasing crime in the big cities, a lot of them are blue cities run by Democrats. Even the people in those cities are now beginning to turn on the Democrats. So with all this turmoil, you're saying the economic impact of what the Fed did this week will determine the election for Joe Biden.
Well, yeah. Well, perfect example. Let's talk about Chicago. Chicago has been riddled with out of control crime for the last 30 something years. They have I think they're ranked to the number one or number two of the deadliest cities in the United States for murder rates. And look at this. Over the last 30 years, you had nothing but Democratic mayors in the city. I mean, that right there tells you right there, people don't care. They vote if they are brainwashed to vote Democrat or brainwashed to vote Republican, they're going to vote that way no matter what, no matter how bad the situation is.
And you don't see the elevation of all these problems, crime, et cetera, as a turning point, turning against the Democrats and Joe Biden.
Well, explain this to me. How in the last 30 years have Democrats with Chicago being the highest crime and highest murder rate in the United States, how have they been able to retain keeping the Democratic mayorship there in Chicago?
But it's never been to this extent before, has it? The crime?
That's also the question. I mean, at what point do people finally get tired of it? Obviously, in Chicago, they haven't gotten tired of it in the last 30 years.
Okay.
Think about that.
We'll see. Mark, a startling prediction from Mark Collinsworth, who up until now thought it was pretty much Trump's is going to win the ball game. But now you're saying, no, that's not so. Joe Biden will be reelected. So Mark Collinsworth, the CIO, Chief Investment Officer of Vera Global Wealth Management, thank you very much for a surprising analysis of the current situation politically and economically with the two being combined. Mark, thanks a lot.
Thank you.